Welcome to our High Rock private client video for September. On the call today is Paul Tepsich, the founder and managing partner and the portfolio manager, and myself, Scott Tomlinson. And Diane is not with us today. So let's talk about what happened in August. Stocks continued to rise and led the way in most asset classes. Bonds were basically flat, slightly negative. The gold silver index, again, negative. Paul, anything to comment specifically here?
No, I guess the only outlier really is, you mentioned, Scott, is gold and silver. And we do have small positions in both, slightly bigger in gold than silver, but and they really are kind of disaster insurance policy that we purchased. Given the money printing that's gone on both fiscal policy and monetary policy. But yeah, neither commodity have been behaving all that well, to be honest.
Well, clearly markets aren't necessarily pricing in disaster coming, but there are some reasons that we want to be defensive and be less aggressive, I guess, as we rebalance client portfolios in their as necessary. One of those is, of course, we believe that the stock market is in a bubble. The difficulty with bubbles, of course, is nobody knows when they're going to end. We can look back and see what happened in 2000, and all we have to go on to a large degree is what we've learned from history. And we know that if you don't learn from history, you're in some cases bound to repeat it. So we do want to keep a close eye on what's going on here. Paul, any comment?
No, I think the only, actually I just sent a very long email to a policymaker, but I think one of the only reasons why equities and other asset classes, including housing and commodities, et cetera, are doing what they're doing is Western democracy government deficit financing. It devalues the currency. It's whether it's the European nations, the US, Canada, it's doing the same thing. So Japan, we've seen it there as well. So God knows where the stock market tops out and what the event is that may drive it lower. But I do think that deficit financing is what's driving it higher.
Something that we do have some exposure to that we talk about regularly is the US dollar, and the Canadian dollar did over the course of the month decline relative to the US dollar, but it did bounce back as we got closer to the end of the month. Paul, do you see anything happening in that relationship?
No, not really, but it really did get pounded sort of in that third week around August 20th to 23rd. But just for our clients, we have roughly, depending on when you're invested with us, but roughly 20% of your portfolio is priced in US dollars. So the currency, actually, the US dollar strengthened by about 1.15% if 20% of your portfolio is in that. So it added value this month by about 0.23. So roughly 0.25%, we saw some value put back into our portfolio because of the US dollar strength.
And of course, we're into an election now. Some of the commentary coming from the various parties has to do with the Canadian economy, of course, and we have not yet been able to see the Canadian economy get back to its late 2019 levels. And in fact, it has stepped back a bit through the second half, or the first part of the second half of the year. And the question is, going forward, is the Canadian economy going to be able to get stronger without any further government financing? And that, I think, is out there right now, and certainly the political parties are dealing with it and coming up with their respective platforms. It would strike me, as we've seen, especially with the Liberal platform that just was announced, that there is some impetus on taxation. taxing the banks, taxing, having a minimum tax for wealthy earners, things like that. We do want to be cognizant of the fact that there will be inevitably some taxation coming down the pipe, and we have to be prepared for that. Paul, commentary?
No, you don't want to hear my commentary on that. As you said probably a year ago, they're going to go after assets. They're going to tax assets, and people who can arguably afford to buy assets, whether it's big Canadian banks that are their assets, they're building our net income, or people buying a $300,000 boat or a $200,000 boat or whatever that number is, et cetera. But quite frankly, it depends which government or which party is elected a government, and if they have a majority, or they can cobble together support for majority platform or majority type policy, they could pretty much do whatever they want. So we do need to be cognizant and ready.
Yeah. Okay. Of course, everybody knows we're always focused on the long term. But we do have to keep our eye on what's going on in the short term. And of course, there's still a lot of uncertainty out there as to where asset prices will go, what central banks' next steps will be, where the economy is headed. Can the economy continue to improve, or will we see another dip in economic growth? So there are many things that we have to keep our eyes on, and that's exactly what we're doing. I think generally speaking, we're keeping a bit of a defensive position posturing for our client portfolios. We always want to make sure we're protecting our client capital as well as trying to get growth. But in times like this, it is important to focus on the defensive. Paul, any comment? Paul, if you're there, you might be on mute.
Sorry, I am. I obviously agree with some of that for sure, and I would just add that we are still participating as we can go through maybe our models, but and how we're doing that, and what we think is a less correlated way to the overall global equity markets, and it seems to have worked pretty well so far year to date. So maybe we should just go into that and
sure. Well,
each model.
With our global equity strategy, we are still underweight global equities. We do continue to rebalance our client portfolios with that strategy in place, which means that from time to time, you may see some sales in equities as we take profits as we pointed out, higher equity markets. Certainly, I think I read we've had 50 some odd record-breaking days in equity trading this year. So as equity prices go up, client portfolios show higher weightings of equities. And so we do take those opportunities as we rebalance to reduce if necessary. So you may see some of that happening now and as we move towards the end of the year, just to keep you up to date on how we're approaching that.
And then I'd say in the tactical model, just on the past month, we did a couple small trades. So one, we were stopped out of our position in a renewable energy company called Boralex, which is largely has wind turbines through France, the UK, Canada, planning on building a lot of solar in the US. As I've said in the past, these renewable companies are very, very expensive. So they're extremely volatile. So we did want to be careful with that and stop ourselves out of a small position to be disciplined. And also we stopped ourselves out of a fossil fuel energy position. Well, 25% of a fossil fuel energy position with a 25% sale in Baytex Energy, which is an oil and gas company. And part of the reason why we did that, number one, because oil was getting hit rather hard at the time, and also and the price of the stock was getting hit commensurate with the price of oil. But the other reason why we did that is, you may recall in our last video, I think we mentioned that we bought a pretty good size weight in our tactical model in a a high yield energy bond called New Vista, which is actually a natural gas producer in Canada, and one we quite like. So that came with like roughly an 8% yield. We were able to buy the new issue in the secondary market at. So that's again part of how we're participating and trying to do so without taking a lot of equity exposure. So we still own Baytex, thankfully. We still have a decent weight in it, and it actually, Scott, today is up almost 9% because they reported on a property they have in Alberta that really they're just starting to drill certain wells, and it was a phenomenal report last night. So the stock has really popped up along with the price of oil itself. Away from those two positions, we did add a very small position in not an energy company, but an energy or an oil field service provider called Source Energy, which is a company I've been involved in before. We bought the bonds in this company. They currently pay us 12.5%. Come February, they'll pay us 10.5%. It's a complicated situation for sure, but one that I think has a lot of torque to it because we bought these bonds at a very distressed price of 25 cents on the dollar. They reported their second quarter, and I had a conversation with the CFO, and I think these guys are going to do much better in the balance of 2021 and in 2022 than they've been guiding and then investors think. So those are really the only notable changes in the tactical model. In fixed income, quite frankly, there are really no changes. We saw the government bond market was kind of unchanged on the month. The only sort of change we've had is we have one bond in the fixed income high yield component that is going to be called over the next number of days. It's an Air Canada bond, and we may replace it with another Air Canada bond. Just kind of getting a little greedy, trying to buy it a little cheaper. But that really has been the only change within the fixed income model. That's it, Scott.
Excellent. Thanks, Paul. All right, folks. Thanks so much for joining us. We try to keep these now as short and sweet as we possibly can. And we certainly want feedback if you have it for us. So please don't hesitate to get in touch. Again, if it's time to review your strategy, it's time to review your wealth forecast, we're always available. Please don't hesitate to get in touch with us. I know Diane is constantly trying to get people to do the reviews. Some people respond quickly. Some people perhaps don't believe they need a review, but we always want to have conversations. So let's get those happening. Anyway, thanks for taking the time, and we'll be back next month with another edition of our High Rock Monthly video.